So organizationally and within the strategy, continued, I would say, very strong growth and momentum. Investors still continue to be very much looking for incremental yield and return and diversification, and the Enhanced Property Fund is benefiting from that. Within the fund operationally, there is an inbound queue today for new investors, whether they're existing investors wanting to add on or new investors wanting to come in. At the end of the quarter, that queue stood at $250 million, with a fairly strong pipeline of commitments looking to follow that. So for investors looking to add on, should there be an interest, we would estimate 1 to 2 quarters, and potentially 3 or 4 quarters if all the rest of that gets signed and committed. So the team is very actively pursuing new acquisitions and development and putting that capital to work very judiciously, which Brent will kind of walk through as we go through the materials today. Any questions on any of the kind of high-level organizational or team information? Not, I will let Brent take over from there. Thank you.
Yeah, great. Thanks, Paul. And hello, everyone. Appreciate the time this evening. Realize we'll be brief in our comments and try to save some time for questions. But as I go through just a few slides I plan on covering, feel free to pipe in with questions along the way as well. Certainly that's encouraged. So maybe to start with, as we dive into this specific strategy, some high-level comments. Since the last time we talked, I think it was a year ago now, or roughly a year ago, really strong performance in commercial real estate markets. This fund was no exception. Continue to be strong on both an absolute and a relative basis. Just over 33% on a trailing 1-year gross return for the strategy. So that's beating our Odyssey benchmark by over 500 basis points. Again, we'll talk about why that is and how the portfolio is positioned and how we think we're positioned going forward, but really strong, both, again, absolute and relative performance. 2021 marked the 11th straight year, 11th consecutive year that we beat that Odyssey benchmark. So not only strong relative performance in 2021, but consistent outperformance over the last 11 years. So really strong track record of performance in this strategy. Do expect that to moderate a little bit. Again, 2021 and even first quarter in 2022, really strong performance. Don't expect another 33% in the coming year. We do think those returns will moderate, but we think we're well positioned in the current environment, in the right sectors and the right areas of the country to continue to outperform that benchmark. As we dive into the strategy, I've talked to this group a couple of times before, and no changes to the strategy, just to reiterate kind of what we're trying to accomplish here. This is a core plus diversified strategy. So we're going to invest in all 4 main property types. I'll add to that a 5th sort of other or alternative property type that we certainly have interest in today, and is about 4% of the strategy as of the end of the year. So we'll maintain diversity across all 4 of those sectors. And that core plus strategy is, again, a little more value enhancement type activity. That's some ground up development, and that's some additional leasing risk. That ground up development is where we're seeing the best risk adjusted returns today. So certainly a focus of this strategy as we put new dollars to work, focusing on development, specifically in sectors that we have strong conviction about, namely multifamily and industrial today. But just a recap of what we're trying to accomplish here, what the strategy is. No changes to the team. Won't spend a lot of time here, but you've got 4 100% dedicated members of the portfolio team that spend all our time on this strategy. Do like to point out both Todd and Mark, long tenured, stable management team. They've been with this strategy since inception back to 2004. So you've got again a stable and certainly long tenured management team that's guided this ship through ups and downs in the real estate markets and economic cycles, and it is performing quite well today, as mentioned. We'll briefly touch here on the investment strategy. Again, this is just what we consider to be core plus. You've heard this story before, so I won't spend a lot of time here, but we will always have at least 75% of the strategy in stabilized assets. For us, that's an occupancy test. Anything above 80% occupied is considered stabilized. And then that other piece, that up to 25% of the strategy, can be in those higher yielding investments, that ground up development, those value add assets that could be anything all the way up to 75 or 79% leased that would fall in that value add bucket. Again, today we're seeing the best opportunities, best risk adjusted value in that development bucket, and making full use of that. And I'll highlight some examples of that as we go along. And then the second piece of that core plus strategy is our leverage component. We say we utilize a moderate level of leverage. We ended the year at 34%, actually ticked down just slightly to 33% as of the end of the first quarter. Our target range is kind of 35 to 40%. The reason we're below that today really isn't because we're paying off debt or anything. It's because the appreciation on the assets has grown, and so the denominator effect has actually made that leverage tick down. But I think you'll see us get back to that 35 to 40% range here in 2022. Our 2022 investment themes, some things we're focused on today. This is a list of things that we meet regularly with a dedicated real estate research group, sort of set the strategy of how we want to position the portfolio. These are some of the key themes we're highlighting for this year. The first is the focus on income and income growth. This has actually been a focus of the strategy for some time, but we believe that if we can hold a portfolio that can outperform from an income return perspective, that's something we've been able to do relative to that Odyssey benchmark. And we can also grow the income off the existing portfolio at a stronger or higher rate than the benchmark or inflation, which is becoming harder to do. We think that sets us up for success. We've been able to do that historically, and we think the way the portfolio is positioned, we'll be able to continue to do that. And we've got some more slides farther in the deck that will highlight what we see for projected income growth on the existing portfolio. The second one is bullet here is something I've already mentioned. It's that kind of core plus or value add component. It's where we're seeing the best, again, risk adjusted relative value, lease to core, build to core, but certainly utilizing that development sleeve where we can. A nice premium to taking that development risk and that leasing risk, again, in sectors that we like, in regions of the country where we have strong conviction. We're still pretty comfortable taking leasing and development risk today, and we're being paid appropriately for that risk. Then the last one here is demographic driven. We're big believers that demographics drive real estate returns. And so again, working with that real estate research group, we've decided to overweight the South and the West regions of the country. Boil that down very simply, that's where we're seeing the best population and job growth, those low cost markets, and we think that will drive real estate returns in the future. And then the last one there is something I've also mentioned just briefly is our alternative sector exposure. Again, that's like sort of that other bucket that we actually have a slide coming up in a few slides that highlights alternative investments, and this is certainly a focus of ours today. It's a growing area of the institutional real estate landscape, certainly something that we're looking to increase our exposure to. I'll give some examples of what that looks like. Things like data centers, cold storage, single family rentals that don't perfectly fit in the traditional four main property types is an interest of ours today. We think there's some nice demographic movements that will benefit those investments. There's, to some extent, in some of those sectors, a yield premium to going into some of those alternative sectors, and we think have some stronger growth prospects than some of the traditional sectors. So taking a hard look at that, we just have one asset in sort of that bucket today. It's a life science asset, but I think you'll see us increase our exposure. In fact, we have in due diligence right now our first single family rental investment that we think we're extremely excited about. It's in 2 cities in Texas. It's one that we will develop from the ground up and sort of develop single family homes in a centralized community that will share amenity space. And there's some really strong growth drivers behind our conviction to that theme. So excited about increasing our exposure to those alternative sectors as well. 13 is just a quick snapshot of the fund profile as of the end of the first quarter. Mentioned just crossed the $5 billion threshold of GAV, so nice growth over the past year in this strategy. That's again from a mixture of investors coming into the fund as well as asset appreciation of the underlying real estate. 60 investments across 25 markets. We'll show you the map here on the next slide of where those are located. leverage ratio of 33% as of the end of the first quarter. And then the bottom two metrics here of portfolio occupancy, very strong metrics for a kind of core plus strategy, 93% across the whole portfolio. Again, we're going to have some vacancy by design as we do these ground up developments and take some leasing risk. So that's a very, very strong number that compares favorably really to a lot of our core competitors that aren't taking as much development and leasing risk. So very, very strong numbers there. We had a really strong year of leasing in 2021.
How much visibility do you have into the occupancy rates?
Say that one more time, I'm sorry.
Generally speaking, how much visibility do you have on the occupancy rates? Are you able to see them a year in advance, or is it, you know?
Yeah, so there's actually a slide later that shows the rollover. Certainly, we know how well occupied we are. We certainly track coming rollover. Some of that is speculative in nature, obviously, and so that number, I would say, we can project that with pretty good confidence about a year out. There again are some assumptions baked into that kind of 1 year look forward occupancy number, but we think we'll end 2022 probably a little bit lower than that, probably the low 90s, maybe 91%. Again, some of that is by design, some of that's the development that we'll do, the speculative development. We feel pretty good about our leasing prospects and staying well leased in multifamily and industrial, certainly where landlords have a lot of pricing power. Tenant demand is very, very strong. Office is starting to pick up, but still a little slow, a little tepid, I would say, in traditional office. Again, that's a smaller percentage of our portfolio. Just 18% of the portfolio is in office. And even that, we're rotating out of traditional office into things like medical office and some other sectors. So long-winded way of answering your question, that we have pretty good visibility into what that looks like. And there actually is a rollover chart later in the slide deck that we can kind of talk about each sector and the rollover we have in the coming year, or actually I think we go 5 years on that slide. So some of that is assumption based, right? But we have pretty good visibility in terms of contractually where we're going to be. Next slide here is the map of where the assets are located. I mentioned 25 markets across the country. Maybe just real briefly mentioned our really liking the west and the south regions of the country, so we've really focused on increasing our allocations to those two regions. And then maybe I'll just point out the metric at the bottom right-hand part of this slide, which is our gateway market exposure. This is something that makes us a little unique relative to the large core Odyssey funds. Much smaller allocation to the gateway markets. There's a couple reasons for that, and if you have your glasses on, you can maybe read what those gateway markets are. But they're really the 6 largest markets in the U.S.: New York, Boston, D.C., L.A., Chicago, San Francisco. We are significantly underweight to those large gateway markets. Coming again pre-pandemic, that was really a pricing exercise where we saw better, again, relative value in some of these secondary markets, places like Seattle, Denver, Charlotte, Phoenix, where the pricing, you were just able to get more yield by going to those locations. And as we looked at the demographic movements and kind of the underwriting, didn't feel like we were taking that much more risk by going to those locations. They were, in fact, sometimes cities that had stronger, in some cases, much stronger growth forecasts than those large metros. So we overweighted that really to get enhanced yield over the last 5 or 6 years. And then certainly the pandemic has accelerated returns in those secondary markets. These gateway markets were the hardest hit, and especially with office and multifamily property in those gateway markets throughout the pandemic. And so we've benefited from a return perspective from that as well. Doesn't mean we won't invest in those metros going forward, but we're sort of waiting for pricing to reprice and get, again, better relative value by going to those large metros. The next 5 slides go through the sectors. Looking at the clock here, I'll try to be brief here, but overweight the multifamily sector, a sector we like. Very strong performance over the past year. Our multifamily portfolio returned about 27% over the last year, so very strong performance within multifamily. Very strong underlying fundamentals. We feel really good about most areas of the country in terms of tenant demand. A lot of that has to do with rising home prices and the ability of people to buy single-family homes, and so they're having to rent for longer. That is certainly aiding the multifamily market, as well as investor interest. There's been an incredible investor interest looking to buy assets like this, and so that has raised prices as well. So we benefited from that. trying to remain overweight, again, because of the rising prices on stabilized product. Where we can, we'd like to develop it at cost. There's an example here on this page, the Spectator in Atlanta, which is near the new Braves baseball stadium. Just rough numbers, we basically were able to build this for about $70 million, and it's worth about double that today at a stabilized basis. Leased it up in under the underwriting that we had forecasted. The rents were 10 to 15% higher than we had underwrote, and then certainly the capital market demand has been very, very strong. So where we can and find sites that we like, we like to find development sites in multifamily and want to remain overweight going forward. The next slide. Yes.
Can you just curious about the student housing market?
Yeah.
I mean, that was something I remember when you had come in the past. You were very bullish on the outlook for student housing, and then we went through COVID. And I'm curious where you come out on the other side relating to student housing.
Yeah, it's a great question. Student housing was one that we had a lot of concern going through the pandemic. That thankfully turned out to be somewhat unfounded, or we were pleasantly surprised with the performance of the student housing assets. So just to back up, we've got 5 student housing assets in the portfolio. 4 of those act very similar. They're rented sort of by the bed, like almost like a traditional multifamily unit. And the one outlier to that is actually located in New York City, and that's leased directly to schools, sort of by the floor or by the section of floors. So most student housing assets operate like the 4 traditional ones. They're leased by the bed to the student. Those actually perform quite well. They leased up a little slower, I'll say 2 school years ago, kind of in the midst of COVID. A lot of that had to do with communication from the schools of, will we be open? Will we have classes in person? What we found out was that even in a hybrid schedule, or once students knew that there would be some sort of on-campus learning, those did fill up. Again, it took a little longer than our traditional leasing cycle. Those assets, again, they work on a different leasing cycle than a traditional multifamily, where you might have a quarter of your units rolling every quarter, and it's sort of a spread throughout the year leasing cycle. Student housing operates much differently. You sort of do all your leasing in the months leading up to that school year. And then once the school year starts, it's very difficult to increase your occupancy at all at that point. And so the concern was, with the uncertainty with COVID, if as schools waffled and sort of held off on announcing plans on in-person learning, that we would sort of miss that leasing cycle, and you sort of sit with a vacant building for months, or really the whole school year. What happened is it took a little longer, and students did wait a little longer to sort of sign those leases. But even in instances in schools where folks were majority online, we found out that students do not want to be in their parents' basement. They do still want to go and live with their peers in pretty nice student housing accommodations. And so we did fill those up. Again, it was a little bit longer of a leasing season for us. But we were able to get those filled for, again, that's 2 school years ago now. And in this past school year that's underway right now, really back to kind of pre-pandemic levels. Again, by that time, schools had their story straight in terms of how we're going to do hybrid learning or in-person learning. In fact, all the schools that we're located at did do in-person learning this year, kind of full bore. And so we saw really actually tremendous lease up ahead of pre-pandemic sort of traditional lease up schedules this year. So pleased with the demand. I'd say we're still fairly bullish on student housing going forward. Certainly keeping a close eye on supply. That was one of the issues we had pre-COVID. I think one of the benefits of COVID is that that's tempered some of the new supply in some of these markets. And so I think we think the outlook for student housing is fairly strong. The other thing we like. Yeah, go ahead.
Related question, but if I could, has the freeze on COVID evictions affected the portfolio at all?
It has not. That's a question we get quite some commonly. Most of that of those regulatory environments have to do with sort of the lower income workforce housing. We don't have any in the portfolio that would qualify for that. So we didn't actually have any instances of that in our portfolio. Certainly a thing we kept an eye on, and honestly still keep a pretty close eye on market by market, because it does affect the broader market, even if it's not actually at your asset. But the quick answer is no, we didn't have any issues with that in our portfolio. And the reason for that is because of the type of multifamily we have in the portfolio.
Another question, sorry, not related. I see a big bump in debt maturities in 23. Do you have a strategy for refis given the interest rate environment?
Yeah, it's a great question. I'm going to flip ahead to the debt slide just so I'll be talking about the same slide here. So a couple things. Not a whole lot of concern as we look at which assets those tie to. We feel pretty good about what's coming up in the next year. I think the other thing I'd point to is that is a very manageable number. It looks, it's the highest on this chart, but in the grand scheme of the portfolio is still very manageable. I think, we certainly have concern on rising interest rates and what that will do to the portfolio. I think the thing that gives us comfort is those first 2 years, there's a couple things. 2022 and 2023, most of the rollover there is stabilizing construction loans. And so it's development deals that are all doing very well and should be stabilized by that time period. What we traditionally do is we match up the debt. We sort of do asset liability matching. And so we match up the maturity of that debt. And so on those construction loans, those shorter term construction loans, by the time they're stabilized or when they stabilize, a lot of times we look to refinance those if they're going to be long-term holds in the portfolio to longer-term fixed-rate financing. And so, yes, that will tick up marginally. I think our cost of debt will continue to rise as the Fed continues to move and interest rates rise. But what gives us comfort and where we think we're fairly well positioned is, we've got almost 70% of our debt in fixed-rate obligations. That's a little bit more expensive than those floating rate, but that floating rate, again, is going to move quickly. And so the fact that we're locked in longer term on 70% of our debt makes us feel pretty good that we'll continue to be below a lot of our peer set in terms of cost of capital.
And am I reading on page 21, the portfolio yield properly? It's about 6%. Is that right?
Say that.
Terminological misunderstanding. What's the portfolio yield?
The dividend yield for the past year was just about 6%.
Okay. So if you had to rely on cash flow from the portfolio, you'd have a nice cushion for, to refinance the portfolio or properties in the portfolio.
I'm not sure I quite made out the question, but I think you're asking about.
No, I think Brent just said the cash flow on the portfolios to manage debt.
Yes, absolutely. Yes. Yeah, we have enough cash flow on the properties to manage debt for sure.
All right, thank you.
I'll maybe briefly go through the rest of the property types and then maybe touch on performance and see if there are any additional questions. But I believe we're talking multifamily. The next is industrial. Again, overweight here to the portfolio. Industrial has been extremely strong, the strongest of the four main property types by far. In fact, I think the index industrial did 51% return over the past year. That's by far and away the strongest sector. In fact, that's the strongest sector return we've ever had in that index. I think there's still room to run in industrial, but don't expect returns quite to be that robust going forward. The nice thing about this strategy is we've been overweight to industrial for the past 7 or 8 years, and that Odyssey Index has slowly caught up to us and shrunk that gap. But our competitors have been doing that by buying stabilized industrial properties. So we're trying to maintain our overweight position that we were too early on by sort of re-upping with development where we can. Kind of very similar strategy to the asset I highlighted on the multifamily slide, where there's still a very nice premium to developing it at cost rather than buying fully stabilized value properties. And so where we can, we're going to try to continue to develop industrial product and maintain that overweighting. I think there's still very strong underlying tenant demand. As we look across the country, there's not many pockets that we're overly worried about in terms of increasing supply. In fact, maybe the silver lining of increasing interest rates and some of the supply chain issues we have is that's going to slow down some of the new construction a bit. And where we can find still sites that we like, I think industrial development is still a nice strategy for us. Next of the main property types is the office sector. This is one we're getting a lot of questions about today. Thankful it's just 17% of the portfolio today, significant underweighting to that Odyssey benchmark. Mentioned at the onset, still fairly slow leasing across the country. Again, a lot of that is return to work and how quickly are people coming back to the office? That is certainly differs by region. If you look across the country or sort of the main markets, I just saw a stat today. It's still at about in the mid 40% of physical occupancy on any given day going to traditional office buildings. And so there's still some room for recovery, and we think that'll still take some time. And so I think the strategy here for office is remain underweight, picking our spots very carefully. In fact, I don't think we have interest in traditional office today until some of that repricing occurs and we have kind of full visibility of what the landlord pricing power looks like, what tenant demand looks like. And I think that could be a year or two away still until we have full visibility on what that looks like. Mentioned briefly, we do like the medical office sector. We made 3 acquisitions at the end of the year in that sector. It's 15% of our office weighting today, about 3% of the overall portfolio. Again, much different demand drivers than traditional office, and think there's some nice demographic drivers to that medical office. And so I think you'll see us continue to rotate out of traditional office and increase medical office, and overall remain underweight on the office sector in general. And then last of the traditional sectors is the retail sector, just 8% of the portfolio. I think a pleasant surprise here within retail, again, don't want to overstate it, it's just 8% of the portfolio, but the assets that we have are performing quite well. A lot of it has to do with the type of retail assets we have. No mall exposure in this strategy. We've never invested in enclosed malls. Those were the hardest hit kind of throughout the COVID period and beyond. So most of our assets are, in fact, the majority of our retail sectors are grocery anchored product. Grocers had some of their best years ever in 2020 and into 2021. And so that's driven a lot of strong traffic and maintained the performance of our retail assets. I don't think a year ago, if you would have asked me if we had interest in increasing retail, the answer would have been yes. I think the answer now is maybe. And that's for 2 reasons. A, the underlying tenant demand is fairly strong. We're seeing actually retailers want to go out and expand and take more space today. The foot traffic and underlying sales data that we have is pretty positive. There's certainly been pent-up demand through COVID, and I think through the pandemic, we've proven there is a need for brick and mortar retail. People still do want to go to stores to buy some things. Doesn't mean e-commerce is going away, but I think for the first quarter ever here early in 2022, we saw e-commerce actually not grow as fast as the previous quarter. So not that it negatively grew, but it did not grow as fast as the previous quarter. And so I think we've proven that there is a need for some of this brick and mortar retail. And so I think being very judicious and picking our spots carefully, I think if the pricing were correct, retail is maybe a sector that we might look to pick our spots carefully and maybe invest in. Don't have anything in the pipeline today. It's still majority industrial and multifamily and some of these alternative sectors that we're interested in today. But I think there are some green shoots in retail, and we're feeling pretty good about the portfolio we have today. And if pricing were to reset and there was an interesting opportunity, I think it's at least possible that we would invest in retail again. And then the last slide here in terms of the sectors is what we're calling the other sector. I'll point you to the bottom first and foremost, and sort of the types of investments we're talking about here: data centers, single family rental, self-storage, senior housing. I think we have interest in all 4 of those, in addition to the one asset that fits within this other bucket today, which is a life science asset in the Bay Area. It's actually one we're converting from traditional office to life science and lab use. That's a sector that's very, very hot in a few areas across the country. One being this Bay Area, sort of Emeryville, Oakland location. And so converting traditional office into lab space is a very accretive proposition and one we're excited about for this asset. You can see it's 4% of the portfolio today, just that one asset. I think you'll see us grow this to 5 or 10%. And we would argue today we're at probably closer to 13% as we think about alternatives. That includes that student housing investments that fit within multifamily, and it fits medical office, which fits in traditional office from a characterization standpoint. But in the near term, I think you'll see us continue to increase this allocation to these other property types. Development slide, won't spend much time here. But just reiterate that the types of investments we're looking at, Industrial and multifamily, there's 7 on this page. They all fit within industrial multifamily. And then most of these fit within the south and west regions of the country. So kind of fit the themes we're talking about at a high level of where we want to increase our investments. Fund performance mentioned very, very strong. Shows the 1-year trail there, outperformance across all time periods at the top. And then mentioned that income return. This is just stripping out the bottom 2 lines here on this page. Our income return, no appreciation, just income return off of the properties relative to that Odyssey index. And you'll see we're outperforming from an income return perspective there. Mentioned if we think we can, or if we can continue to outperform from an income return perspective, and then grow the income on the portfolio, we think that really sets us up nicely for success in the future. And so the next couple slides get into the income growth story, which as I look at my watch, I'll try to be brief here, but same property NOI growth. Here's the history of what we've done over the last 7 years, nearly 3 times what the Odyssey Index has done. That's a same store analysis, so it's the same assets looked at from 2015 into 2016. So it's anything we've held. It doesn't include any new acquisitions. And then we reset that same store each year, that same property look each year. So strong history of growing the income on the portfolio. And then at the right-hand side of this slide, you'll see our projected growth over the next couple of years, 8.6% in 22, 10.8% in 23. And then as I flip to the next slide, you'll see kind of our 3-year look forward, where we're projecting 40% NOI growth. Very strong number. That's coming from digging into a little bit of the detail on the right-hand page here, a mix of stabilized assets where you're getting growth from actually all 4 of our the diversified property types, as well as certainly a significant amount of lift from the value add development bucket, where you're having an asset maybe today that's just dirt. You're going to build an asset, stabilize it, lease it, and have it be a fully income producing asset. And it's certainly driving a lot of that income growth in this strategy. So I'll maybe pause there. We touched briefly on the debt slide, and slide 25 is usually where I wrap up. So why don't I see if there are any other questions?
Any questions? Can you talk a little bit about the potential impact on the portfolio with the rising rate environment, kind of where we're at?
Yeah.
Yield curve?
Yep, for sure. So I'll maybe flip back here. So it's at a basic level, it's going to cost more to borrow, and so we think that we will see that impact in our debt service line item. And so again, the nice thing is 70% of our loans are fixed rate, and so we think we'll actually, relative to our peer set, actually look more attractive from a cost of capital because we have so much of our debt in those fixed longer term rates. But it will become more expensive to borrow. We do certainly have the ability and the cash coming in to do all cash transactions. But those rates, even if they do tick up, and they will tick up, is still a spread to cap rate. So it still is accretive to borrow today. What we track is kind of where cap rates are at relative to the average cost of debt, and it's certainly still accretive today. But we're keeping a close eye on interest rates, and certainly that floating rate interest will get more expensive. But we think we have a nice gap there yet today. And again, I mentioned just briefly that maybe the silver lining of that is it's going to become more expensive to finance these deals. We think that will slow some of the supply pipeline that we're seeing across the country, and we're hoping to sort of take advantage of that on the existing portfolio, and deals that we have sort of already locked in that maybe we have the ability to do all cash can still pencil out for us.
I don't know if you stay awake at night ever thinking about the portfolio, but if you had to pick one sector or geography that would keep you awake at night, what would it be?
I think it's the office sector today. I think if you would have asked me at the onset of the pandemic, retail was the one that we were the most worried about. You think about retailers shutting their doors, and we worked with a number of retailers across our portfolio, underlying tenants to keep the lights on, work on rent abatement, rent deferment. And so that was sort of the big headache, if you will, that kept us up, I'll say, early on in the pandemic. That has now shifted. Again, I mentioned that sort of the bounce back in retail. We're feeling a lot better about retail today. It's office that I think you're going to see some repricing. We've seen some repricing, but I think because of the nature of office leases being longer term, a lot of those are 10 or 15-year type leases. We haven't, I don't think, taken all the pain as an industry of what this new sort of hybrid work style looks like. What I mean by that is I think it's pretty clear, although it remains to be seen exactly how this plays out, that most tenants will not need as much space. That obviously trickles down to landlords and the space needs and how you're going to lease, the office space that you do have. And so I think that, again, leads us to sort of A, being thankful and underweight to the office sector, and then B, taking a hard look at municipalities and certain segments of the country of, is there new leasing activity? Is there new business formation going on? Even if there is new business formation, how much space do those tenants need? And I think we're still in a correction phase of underlying tenant demand. So I think that's the big one. And then certainly, I would say interest rates and sort of what the Fed does, that trickles into the broader economy. Real estate, and then I'll add inflation to that sort of general comment. Private real estate has a really good track record of outpacing inflation in times of inflation. And so private real estate returns have outpaced inflation. I think it's like 85% of the time. And so we've got a strong story there that, again, that relates to our ability to raise rents along with rising costs. But if the Fed doesn't do that correctly or too quickly, that works well in real estate in an environment where the economy is growing, and so a stagflation environment would not be great, and then you probably would not be able to push out and increase those rents at or above the level of inflation, and so that's certainly a concern as well.
If I have time for one last question. Non-CBD versus CBD, I assume non-CBD is helpful to you, but I'm not sure. Is that so? Yeah,
I would say it's been a focus of ours, and I'm flipping back to the map here just to reiterate. CBD is not exactly the same as Gateway, but you can kind of think about it that we've been underweight Gateway, we've been underweight CBD. A lot of that has to do with pricing historically. What we saw through the pandemic is that those suburban locations significantly outperformed. And so our overweight of those suburban locations has been accretive. I think you're seeing people come back to city centers, but not so much on the office front. Again, that has to do with how and where people work. I was just in New York a couple weeks ago, and it's busy in Midtown with the shops and restaurants. But you go downtown, and the office buildings are not full. And so our apartment projects in the city are performing very well. People are living in the city again, but people are not going to the office 5 days a week like they were. And so that has trickle-down effects that leads us to underweight CBD. There's certainly a preference to suburban locations, both in multifamily as well as probably in office and retail today. Doesn't mean that won't shift back, but I think there's more room to run in suburban locations than CBD.
Are there any other questions? All right. Thank you so much. This has been terrific. Thank you for taking us around the country here and around the portfolio. It really gives us a better understanding of how you weathered the pandemic and how you're positioned going forward. So really appreciate your accommodating us this Wednesday evening.
You bet. Happy to do it, and appreciate your guys' business. And if there's anything else we can answer, feel free to reach out.
Thank you.
Will do. Thank you.
Thank you very much.
Thanks, Paul. Thanks, Brent.
Bye-bye.
Well, that was great.
Yeah, good review.
That was a good review.
Pretty comprehensive, yeah.
Yeah. Any follow-up questions or thoughts? We're good? All right.
And if anything does, you could always email to me and I can
No real
reach it.
surprises there, right? Talking about office space and industrial, it's booming everywhere.
Yeah.
The big surprise, well, depends how you look at it, it's just how strong those real estate returns were.
Yeah.
I mean, through the fourth quarter was over 20%, and then with the first quarter returns coming in over 30%, yeah, that won't sustain. It's on a lag of where the equity markets are, right? And
right.
So I think that's the big thing, but they've done a nice job.
I kind of feel like a banker for bringing out 1% industrial property appreciation, but we didn't talk about expenses or fees. As a newbie here, I'd be curious to know about that at some point.
There's two components to their fees. There's a flat and then there's a performance fee, and I believe the flat, if it's not 1.1%, just shy of it, but it's over 1
Okay.
as far as their flat fee. And then there's an incentive fee for them if they outperform 11%. So it just depends on the
It's a
portfolio.
flat 11%.
Well, that's their hurdle.
That's a hurdle.
That's their hurdle. And so, but think of it as the fixed fee is that 1%. And they do, may not be captured here, but it is in the performance report. We know we do put net of fee returns in.
Okay.
Yeah, in the performance report that we show. I mean, it's in their information as well, but I think I saw up there mostly gross. Mm-hmm.
And just so everyone is aware, right, the way our relationship works with Vanguard, well, Brian's, happy to come in and help facilitate this. This is not under the Vanguard or HarborVest umbrella. So it is our decision as a board, separate and apart from the Vanguard relationship, about whether or not we might want to continue with it or, look for another fund or, or sell any of the allocation.
What percentage of it is in the principal, do you know?
Well, the target allocation is 5%, and I think we're just below that. And well, now with their appreciation, so now it's over that target, 6.1%. The target allocation is a 5.
No, I know as well.
The OPEB is at 10%.
Right, larger.
Has a higher allocation, same principal fund, just a higher allocation. Mm-hmm. And
What is
that one, I think, is,
What's the Wi-Fi?
9.3%.
It's right up behind you.
So they're a little bit behind on the OPEB.
So if anyone wants to talk about, the position sizing or making any changes, we can do that at a future meeting, because we would have to notice that and put that on, that we would be voting on it.
Sure.
Right?
It's all included in the 10%, or did we go to 15?
No.
5 to 15, or was it 5 to 10 in private?
On private equity, it went from 5 to 10,
Right.
increased the target from 5% to 10%. The real estate allocations haven't shifted.
Right.
So
That's separate from.
that's separate, that's right. So, but it's a good way to think of it as far as, let's call it an attention, a 15% target to private equity and private real estate. Now, private real estate, you have more liquidity than private equity. Private equity is, you're really locked up for that 10, 12, 13 years. Private real estate, you do have quarterly liquidity. You have to give 90 days notice, but then they can provide liquidity every quarter.
Do you know how big we are? I saw 150 clients. Do you know how big we are relative to the
I don't know.
average?
To whatever.
With the average size investment, I'm just thinking about liquidity. If we're
Mhm.
150 and we're about normal size, it's probably decent liquidity.
Say that one more time?
Yeah. Are waiting within their portfolio.
Their
How
portfolio.
big
Within
of an
their
investment
portfolio.
client are we?
Yeah, right. Well, I think on the, not including leverage, I think the portfolio side was like about 3-point-something billion. And then with leverage, that was the gross, that was over $5 billion.
$5 billion.
Yeah, so, I don't remember what our dollar allocation is, but I think that'll be pretty small.
Yeah.
Pretty small allocation. But yeah, you're right, it's 100 plus
Something
investment.
like $25 million is a rough number for what we have in there.
Right.
So assuming normal conditions, we should be able to get out if we
Yeah.
needed to get out.
Yes, what happens in crises, including in 2000 with COVID, even in principle, investors may have put it to redeem, but they didn't, say you wanted to redeem 10 million, they might have said, well, we can do 5 million this quarter, or 5 million next quarter. We just, couldn't raise that cash in those times. But I would call this more of a normal environment. If you wanted 10 million, I'm sure the queue would be easy to get out. Yeah. So we use the other 85% of the portfolio really to is your liquidity we have the monthly pension payments. That's our main liquidity need. And we could more than meet that through the public equity, public fixed income. Yeah.
All right.
All right.
Should we move forward?
Yes, yeah. Well,
You're up, Brian.
Maybe I'll try to give back some time, but not rush it at the same time. Jared, do you have it to bring it up? And
Yeah, I
I
can-
guess a lot of
I can-
people have their
I can
laptops
put
or
it up.
computers. But, you know, since, you know, while he's bringing it up, since we last met, you know, the returns have only gotten worse really, and that's, you know, it's really due to the fixed income market because of rising rates, but that leads over to the equity market, and equities have sold off. But what was really interesting in the first quarter of this year, maybe I'll just wait a moment.
Yeah, just give me a second.
Yeah.
Chris, do you remember when you sent that to us?
Monday,
Yeah.
Monday at,
I didn't know, you didn't have it?
Monday, 4:57, late in the day.
Did your son win?
What's that?
Did the team win?
No, we didn't. They 8-8 doing extra innings.
No.
Oh.
Yeah, it was a real heartbreaker.
What league?
Freshman, high school,
Oh,
freshman baseball.
or Ludlow or?
No, Newtown.
Newtown.
Played Newtown. New Milford. They were good. They could hit well.
What position does your son play?
Second base.
I played that in high school. I loved it. Softball.
Which is high school?
Was that?
Which high school?
Newtown High. Newtown High.
You could probably search
Yeah, you didn't send it?
Vanguard.
It should
But
be.
you have
It
it.
was Chris sent
No,
it
yeah, definitely
separately.
have it.
Yeah, should definitely. Were you on this trip? Maybe you weren't even on it.
No, it's 2 weeks ago. That's not it.
Vanguard and principal presentations, Monday, April 25th, 4:57.
I'm gonna forward it to
I've
you.
got it
I'll
open,
forward it to. Jared, I just emailed it to you. I think I got it to you.
This should be it, right? No, that was the one from me. You just sent it to me, Karen?
I think so. I might have sent you. that.
No, what's the first one? What's the top one?
That's from me.
Oh,
That's the one from me.
All right.
Great.
Yeah, just go to the, there it is, the top.
No, that's
Oh,
the one that I sent.
well, I just sent it to you
Well,
again.
maybe,
second one.
if
What's
the
the,
X
what's
out
the
of
second
Go
one?
into your inbox.
No. See it, the third one down. Oh, that's bossy.
No. This is weird.
Well, if you go into your inbox, I should be at the top of it. I'm connected to
Yeah.
Wi-Fi. There.
Maybe the one below? Inbox?
Exit your search. Do this week. Yeah, how do I get out of that?
Right there,
Oh,
exit
we
your
go.
search.
Yeah.
Not in there yet.
No,
You have it filled in?
no.
Sure, I have the 25th of April.
Yeah.
Which is Monday.
Yeah, 4:57. Late.
There it
Right
is.
there, that's it, you're on it.
Right there.
That's it.
It's the one from me.
Oh.
Oh.
I don't know why
There it is.
it's pulling that, it keeps pulling that one up and not showing me the original one,
there?
because I think that was, that was
Arrow?
fine.
Oh, right there, go there, yeah, go there, the clip right there. There you go.
There it
There
is.
we go.
All right,
There you go.
That one.
yes,
Okay.
all right. There we go. Yeah, okay, Jared, if you can scroll down to page 4 and.
Yeah, let me just share this.
Okay.
Why is Mary Beth Allison in here?
Okay, yes. If you could stay on that screen, right. I know we have folks on the phone, so you could jump in at any point too, but, you know, the big story from the first quarter, I really think, is the fixed income returns. So right in the middle of the page is the returns for U.S. bonds. This is the broad market. And because of the big interest rate increases, you know, fixed income or bonds were down 6% for the quarter. And that's one of the worst quarters in the last 40 years. To the left of that, where I usually start, is equity. This is again through March. So U.S. equities and international equities very close, but down 5.4, 5.3%. So it was a real anomaly that if you were a very conservative investor, like a 30% equity, 70% fixed income, you actually underperformed a portfolio with 70% equity and 30% bonds, just because of how poor the fixed income returns were in the first quarter. So, you know, that there was really no place to hide in the public markets for that quarter. And if you scroll through, I'm going to skip, maybe I'll skip page 5, but I could come back to it. It's a topic we discussed lately, but here's what's caused the pain in the fixed income market. This is looking at the yield curve, or what yields are along different maturities. And the big move is that greenish line. The big move has been on the shorter end of the curve. That's because the market is moving in anticipation ahead of what the Fed is kind of signaling what they'll do with interest rates, right? So the Fed has only raised interest rates 25 basis points, but you see that 2-year yield in 1 year, it's up 200 basis points. And the longer end of the yield curve, the 10-year, which is more driven by inflation expectations and growth over long periods of time, it's still relatively anchored. It's up, but just not as much in the short end. So the bottom line here, I guess, maybe as we look forward, is, you know, Vanguard has a fixed income team, and we were talking to one of the portfolio managers, and as of right now, you know, thinks most of the movements in yields has happened already in anticipation. So, you know, yields will probably be, or interest rates will probably still be volatile based on, you know, what happens to the economy. Like, you know, can the real estate market that we just heard and the rest of the economy handle it? There's usually a lag, 6 to 9 months, between from when interest rates happen to the effects and the trickle down. But the biggest part of the move likely happened in the yields. Carol, did you have a question? Oh.
Well, it's a million questions.
Oh, yeah.
That.
Right.
Never without a question. But
Right.
I guess, you know, that view, most of the moves already happened. That's a view that's as of today, the end of April, or this was?
No, that, you know, even as of last week, you know, we were meeting with the team and the portfolio manager who manages all of our investment grade credit. And so what you've seen is, what we've seen from the Vanguard flows perspective, we see all the flows into our fixed income funds, is, you know, a lot of retail investors come out of fixed income because they were using a lot of short duration funds, like a year, 2 years, as a money market proxy, because if you put any money in the money market, you were getting nothing, right? And so a lot of investors were, okay, I need some yield, I'll go to a short duration fund. And you see, like, what happened to a short duration fund with 2 years, and, you know, yields move up 200 basis points, and that caused a lot of retail money to go out, but they are seeing demand more from the institutional investors for investment grade credit. I can attest to that. I work with some corporate pension plans, and, you know, they're still trying to match the duration of their assets, their liability, and there's been a pickup. As their funded status has gotten better, they sell equities and they buy fixed income, because most corporate pension plans are closed or frozen. They're not accruing benefits like a public plan. A public plan still wants big returns. So that's just some commentary on the fixed income market. Related to this, and we talked about this a little bit, so I'm gonna go back to slide 5 and then forward to slide 7. But slide 5 looks at the different segments of the market, and if you look at investment grade credit, it's down more than treasuries, down 7%, but spreads haven't widened all that much, And high yield, which is usually more sensitive to the economic cycle, high yield's only down 4.8%. And so really, I guess there's still, even though with the rate increases, no one is looking at a recession in the next 12 months. And so therefore, not expecting any kind of big default cycle, at least in the short term. So again, you have to give more time for those rate increases to happen, but there hasn't been really stress in the market. And so let's go to page 7. It's a little hard to see the details, but you'll see just bigger picture. These are just looking at spreads, so yields, when I say spreads, yields above treasuries.
Yep.
And, the dashed line is more of the median. At least in U.S. credit markets, those yields have widened, but they're not stressed. Look at the big spike of like in COVID. And if I went back to 2008, it would have been even larger, that spike. And then to the right of that is the corporate high yield. Those yields or the spreads over treasuries haven't even gotten back to median. So no signs of stress in the corporate or high yield market. What I will do, and I think it'll be, I don't know if it's the next meeting or 2 meetings, is when we update our capital market forecast as of the first quarter, and then that'll help with setting the discount rate. I think it'll look more attractive to fixed income because yields have moved up. When I say more attractive, what are expectations looking forward? And I think it'll look even better for equities because equities, through the end of last week are down over 10%. So forward looking, it should be more attractive for those asset classes.
What type of a rate environment, kind of in the tightening environment, you think is being discounted into the market right now, the fixed income market?
I think the market is about 7, 8 rate hikes. So is being discounted to the market. But that's been more on the short end, and again, 10 years, not too much. And the big thing to watch, or what investors really watch, is does the curve invert? So the short yields go higher than long yields. We inverted for 1 day, but that's usually a predecessor to a recession.
Yeah, it's interesting, right? Because commodities seem to be, when you look at the forward curve across commodities, they would be indicating that they're so steeply backwardated, right? So they would be indicating perhaps a recession. But the bond market's not quite there.
Not there, not quite there yet. No.
Okay.
No. Page 8 is just a different slide. I may have shown it in the past, but it's, we get this data twice a year from S&P. So this isn't even Vanguard data. This is a report from Standard & Poor's. They call it SPIVA. It's Standard & Poor's Index versus Active. And this is a study that says, okay, here are all the different parts: equity, international, small cap, fixed income. And I'll just use the top line as an example. The bottom line is very hard indexing over longer periods of time. Just most active funds underperform. So let's use the very top line, like all large cap funds. And this is as of 12/31. So what this is saying on the 1 year basis is that 85% of U.S. large cap funds underperformed the benchmark in the 1 year period over 12/31. And then if you look out over 20 years, 94% of the funds have underperformed the benchmark. Really, and so the red is just kind of saying the majority of funds. And that goes across, most of international, not all, international small cap may be a bright spot. And a lot of fixed income as well, with the exception of some investment grade funds. So I just thought it would be in good perspective to provide the committee as far as that whole discussion around active and passive. Not saying that active can't underperform, but persistence is tough over time. And if you're going to invest in active, one thing that we always believe in is you have to be patient because it fluctuates. And 2, even in active, the biggest thing to outperformance is usually having low cost.
So one of the topics that came up, last month, right, was about the investment grade bonds.
Yeah.
And thinking about perhaps shifting the allocations that we have across bonds to that. So this kind of falls into that. Did you give any thought to?
Not yet, because, just what I was alluding to is we don't have our capital market applications out as of the first quarter yet. So our capital market forecasts are still as of 12/31. There's usually a 2-month lag after the quarter. So the next, whether it's the next meeting or 2 meetings, then I think we'll have new capital market forecasts, and we'll take into consideration what happened here in the first quarter. So then I'll be glad to look at an allocation of how much additional return could we expect for, say, having an overweight to investment grade credit. But that's why I didn't include it here.
I have a question that may be a little bit outside the normal perimeter of questions. But if the situation in Ukraine dramatically escalates, if hypothetically the Russians explode a nuclear weapon over Black Sea, which has been hypothesized, what would happen to, what could a capital market effect be projecting? Do you have any thoughts?
No, I mean, I don't know anything specific there. I mean, of course, that creates huge uncertainty, and the markets don't like uncertainty, you have volatility. I think that, let's take out any more additional escalation. I think the bigger concern right now is on Europe, and that Europe, more reliant on Russia, energy, et cetera. And so we still have high inflation there and the commodity costs. So I think it's more of like a worry that the European Union won't be able to, or the ECB won't be able to put through any rate hikes, and they still have high inflation. So there's more of a worry of a recession, I would say, in Europe right now, later this year, than the U.S. That'd be the best way to think about the risks in the market. But what would I expect? I would expect equities to sell off, just generally speaking.
Right.
And a flight to safety, which is typically the fixed income. But other than that, I don't know how to hint that to Right. Yeah. I did include last meeting, you'll recall, a slide on geopolitical crises. That was, usually 6 to 12 months later, the markets look past it. But we'll see what kind of escalation can happen. So let me just speak just briefly to the performance of the 2 plans. Then that starts here on page 9. So based on what I said, or kind of captured there, no surprise on the 3-month basis, the first quarter for the pension plan, down 4.01%. The OPEB, which is later in the deck, but I'll just give you the number now, 4.31%. So down a little bit more of a risk profile in the OPEB plan. Fiscal year to date, still just marginally above 0%. So, certainly nowhere near where we were last year. But, those returns couldn't persist either. So still positive in the fiscal year to date. At the bottom of page 9, I'll just talk about cash flows a little bit, give you a sense of money in and out. In the first quarter, we only had $80 million of calls from the private equity managers, actually just one fund. But in the first quarter, we had $567 million in distributions. We had another meaning the pension plan received $567 million. And in April, we also had $420 million in distributions from some of the managers. So to give you a sense of that cash flow. And of course, Jared gives updates on where we are with pension payments. I know as far as the HarborVest fund, which is the newer investment, there'll likely be a capital call in the June timeframe.
Can you repeat those numbers?
Oh, yes. So
they're really large. 567 million?
$567 million in distributions from Lexington and Mesereau.
The fund itself?
Like in combination.
In total?
Well, they paid out into the plan. Yeah, plan received that cash.
But we have a total Fairfield pension plan in the town of $465 million market value.
Oh,
Doesn't that seem really
sorry.
big?
567,000.
Thank you.
I'm so sorry. Sorry. I'm used to working in millions. Yeah, thank you, Cash.
It just seemed off.
Yeah.
Just a
I've done that with my wife.
567,000.
I've done that with my wife too, you know,
Yeah.
after banking years, you say, oh, we have to cut a check for $14 million. You just said $14 million, I meant 14,000,
Sorry, yeah.
or 1,400.
Yeah, our commitment's not even that.
$14,
Right.
man.
All right, thank you for,
Thank you,
okay.
Yeah.
Okay, so I assume it was $80,000 of calls.
$80,000.
And $60,000, it's a really big
We're not
call.
overcommitted yet, yeah. My apologies. So that's really what I want to touch on, cash flows. Within the portfolio, you know, we have the 4 index funds, so they're tracking the benchmarks. The international fund, you'll see, it has a big divergence against the index, and we've talked about in the past, that that's really due to fair value pricing. You know, whereas, you know, something can happen in the local market, but the U.S. markets don't price until 4 o'clock, and you have a mismatch of pricing. So it catches up over the longer term.
So it's not due to FX. I mean, that could be part of its translation in the short term.
Yeah, so if you're on page,
all over the place.
if you were on page 10, like,
Yeah.
you know, you see the international fund for the 3 months, well, it's down 6.07, but the index was only down 5.3, and I thought it was supposed to track, and it is, but in international markets, you have this, what's referred to as fair value pricing, and that really accounts for the majority of why that spread is.
Okay.
But it works itself over time. So if you went right all the way to the 10-year number, you could see, you know, the index, the fund was up 5.8%, and the index was up 5.9. So really, that was kind of fees over that time. That's what you would expect.
Got it.
And then obviously, we got a long, we already heard from principal that talked about the returns, and that's reflected in the performance report as of March. They gave an update. The numbers on page 11 of this performance report for principal, that's as of the 4th quarter. They obviously gave you the most recent update through the 1st quarter of this year. And then I'm flipping ahead to page 13, I already talked about the OPEB plan performance, but it's, you know, mainly the same funds, but a bigger allocation to private real estate and a little bit more equity exposure. That's, you know, that's what I had in a nutshell, so as far as a summary. What other questions?
Hey, Brian, it's Jack Mahoney. I've got a quick question for you.
Hi, Jack, yes.
Yeah, hey there. Could you just go back just a little bit and just mention why you think there could be a recession sooner in Europe than the U.S.?
Mainly because of how much of their commodities, you know, so Europe imports a lot from Ukraine as far as like the soft commodities like wheat, and then they import much more than the U.S. in oil and gas and from Russia.
Mm-hmm.
And so those costs just leading to pretty high inflation over there, just like the U.S., but perhaps more on the commodity side. And they're not seeing the wage growth that, you know, the U.S. is experiencing. So they're more, it feels more of a stagflation environment over there. They're not getting as much growth, but still experiencing very high inflation, and maybe a little bit more so because of the commodities as opposed to the U.S.
Got it. Okay. Very good. Thank you.
Yeah, so, yeah, the ECB was expecting the hike by the end of the year, and I think at least our economics teams thinks that might be pretty hard to do in this environment.
That makes sense. Thank you.
Okay, of course.
Tough environment.
Tough environment, yeah, certainly. You know, and that's reflected in April. You know, equities are now down over 10%. You know, so that's just a peak as far as, you know, where we're at. Yeah. So,
Okay.
let me leave it there unless there's other questions. Being sensitive to time, and I think there's other things on the agenda. I know we went a little long on principle.
Good. Any questions or thoughts? Hold the course?
Yeah, I mean,
Yeah.
hold the course, and I think that, it'll be, the big discussion will be later in the year with the actuary, and we'll update the capital market forecast, and I think that's the time to think about what happens with the discount rate, if anything, and or if an allocation makes sense to.
Could I ask a question to Jared? If hypothetically something goes to Pluie in Europe, are we geared up to handle pensioner questions? People might call it a panic saying the town won't be good for it, things are going to hell in a handbasket. I'm not talking about rational or well-reasoned or educated comments, just, emotional comments and questions. Are we geared up to handle those kinds of?
We handle emotional, irrational questions every day of the year. I mean, we haven't prepared specifically for that, but, we do our best in any situation, any emergency or, any situation like that. I think it will be better once we have, we'll probably feel more prepared once we have, Milliman fully in place, because they would have
Scripts and all that.
Yeah, and I'm sure there would be some initial probably trying to preempting questions and sending out communications that way, and then also they have their call center, they have email, all the forms of communication that they would be sending out. So
That's where their call center is located.
Don't quote me. I think it's in Michigan.
So, yeah, Minneapolis or Minnesota.
Yeah, somewhere in the upper Midwest.
Yeah, right.
Upper Midwest somewhere.
The U.S.
Yes,
US.
yeah, definitely U.S.
Yep.
So you don't see a recession coming over the next 12 months, huh? You say it's low. I don't know what low means. I'm on page 19.
Yeah, so I was just gonna have flip to you, like either 18 or 19. So 19 has some data on what we talked about as far as like those an inverted yield curve. You can look at inverted meaning the 2-year and the 10-year, or you can look at the 3-month yield versus the 10-year. And the 2-year, 10-year only inverted briefly. The reason that is important because again, you had an inverted yield curve prior to 7 out of the last 8 recessions. When you have an inversion between the 3-year yield and the 10-year, meaning the 3-year yield higher than the 10-year yield, that's predicted 8 out of the last 8 recessions. So that chart to the right was saying, and this isn't the case in April now, that only 50% of the yield curve is inverted. So lower chances of recession. So you're still seeing good wage growth. You're still seeing companies with good profit margins. They're able to service their debt. They took out a lot of fixed rate debt at very low rates. So no really pressures for them to service their debt. So you're not seeing the stress in the fixed income markets. You're seeing the higher yields because of what the Fed is expected to do, but you're not seeing stress in spreads or with companies.
What about consumer debt? Does that play into this?
Not specifically here, but I think the bigger part to that question is what the higher rates do to mortgage rates. And so, you've seen mortgage rates now go over 5% for the first time in, I can't remember what they recorded, 10 years, 20 years. And that works with the lag. It doesn't sap demand right away, but it makes it harder, to afford that home and to borrow, the costs go up. So there is clearly an effect, on the consumer with higher rates, but that translates really through the mortgage market. Mm-hmm.
And where do people have to start paying back their loans for college debt, right?
Right.
all going away.
Yeah, right, go on, can't wait. On that federal debt?
Maybe that's for the next generation.
The joke is that the children of the plumbers are gonna be paying for the debts of the doctors and lawyers
Yeah.
of the future.
But if they do ever turn that back on, it's just more debt and just.
Yeah. There's no question that, you know, some pockets of consumers have a lot of debt to service, for sure. But, you know, the good thing is you have really low unemployment again, and so, you know, there's jobs, and those are the big components with respect to the economy.
I've heard Carolyn mention backwardation twice in 2 meetings, and I've only heard the term since the CFA exam of like 25 years ago for me.
Right.
Does the commodity market, situation give you any pause?
I'm just trying to think of different pieces. I mean, I think some of the commodity prices have started to come off their tops, but not with respect to anything that I recall from, you know, thinking of inflation, right? Sorry, that carries over into inflation because energy is the biggest component of the commodity market. We showed that last time, not as far as predicting any type of recession.
Dr. Copper would beg to differ with you, I think.
Certainly not expertise, but
Good old Dr. Copper is always, it's the one that's most sensitive to the economic conditions.
Right. And you're probably seeing a lot of demand there because of the electric batteries and et cetera. Copper is a big component of renewables.
It's a big pull in a lot of things, right? I mean, and construction, home building, a lot of copper.
Yeah.
Wiring, and so it's a good indicator. But China shut down, parts of China shut down, it puts a wrinkle into everything.
Somebody made a comment that it's predicted 15 of the last 8 recessions.
Yeah, copper doesn't go wrong.
No, well, the comment was that occasionally it does, that 15 out of the last 8, get it?
Oh, 15 of the 8, not 18. 15 of the last, it's weird times. It's really strange times. Well, you know, I'm happy to have broad exposure.
Right.
Rather than narrow exposure that you turn out to be wrong on.
Right.
Okay. All right. You guys still with us? All right, shall we move?
Somewhere.
All right, let's move on. Jared, you're up. CFO report. You got it up and running.
Got it. Running. Share it. All right.
Sorry about that million comments.
Do you guys want hard copies? You guys who are at the table? Helpful to you?
I do for the minutes, please.
Woke me up.
Thank you. You guys want a hard copy?
$1 billion call.
Thank you.
4 pages now, used to be 3 lines.
Yep. Up in our game. We're up in our game, Chris.
Way to go.
Okay. So we'll start with the town pension fund. And again, just to remind everybody, this is the fund where the money flows through for various purposes that we'll talk about. But the top line, the beginning cash balance, reminds you about the second line, the town employer contribution. That's the town of Fairfield, what we budget for a contribution that typically happens in September. Next line down is our transfers in from the funds account. So this is the sort of the umbrella account where the money comes in from in order to pay for the pensioners' payments on a monthly basis. And you get a sense of how much has gone out to date. Looking over, so over the first 9 months, it's been 12.4. We'll get to a more precise amount actually below, but that's the most of the transfers in from that account. And the employee contributions after that, small amount of interest and dividends, some other smaller amounts in the sources section. The uses of cash, monthly custodial amount, that's minimal. Payments to participants, this is the amounts that go out to the pensioners. And so if you look all the way to the right, you can see what that amount is. And you have associated taxes, healthcare. We have some legal services, which I will, I'll get into a little bit in my next report. I'll talk a little bit more about that, but this is to pay for the pension plan, to amend our town pension plan. We have tax preparatory audit fees, which are paid to PKF O'Connor, investment management for Vanguard, actuarial fees, which is just, at this point in time, the only thing in there is a last payment to H&H, our old actuary. We haven't gotten a bill yet from Milliman, which I expect to get soon. And then the next big one is the transfers out to the funds account that goes to gets invested.
Jared, I know we talked about it before. So the employees are only, it's not on a monthly basis, it's just kind of once a year now?
Yeah, we do it in, we've been doing it in chunks. Typically, this is half, so it would be twice a year that it happens.
Okay.
That the money goes in from employees. Any other questions on that one?
On the fees, I mean, I'm assuming that's, oh, I see that there's people's fees. This would be the total, and just investment management fees. But what about like custodial fees, people's fees, like the rundown of the other fees?
Yeah, so.
Have you picked that up yet?
The custodial fees are up in that's the first line item in the usage.
Got it, thank you.
Monthly custodial.
Okay.
And then there's people's fiduciary.
Yep, okay.
Liability insurance fee. Next page runs the same way. But this is fire and police, the fire and police pension fund. So again, we have the contribution from the town, cash transfers in from the funds account, and the same methodology for the employee contributions there. They are slightly, they run about equal, at least at this point in time, in terms of the amount that's being paid out to the pensioners between in comparison to the town employees. So between town employees and police and fire, they're roughly equal in terms of the amount that gets paid out. And then, you know, with the legal services and those types of fees, they, for the most part, just get allocated to each of the funds based on their, you know, their proportion of the value of the fund overall.
That's what I was going to ask.
Yep.
So even like the legal services and stuff like that, that's kind of split. It's not, you know, it's not special work for one fund over the other or anything like that. Or
Right. So, you know, and probably what will happen with that one, because the work that's being done right now is specifically for the town side, but we will get into doing work on the police and fire too, to do their pension plan as well.
Okay.
So that'll be allocated as well.
I've got the world's stupidest question. Has the name changed from fire and police to police and fire, or vice versa?
Good question.
That's really a stupid
I think
question.
I don't know.
I'm just curious.
I usually refer to as police and fire.
Eric probably had something to do with that, maybe. Does it matter? I mean, is there a legal entity? I don't know if it's, you know, is it just...
I mean, for our reporting purposes, no.
Yeah.
If we were filing an official legal document or something, then yes, that could be an issue.
Okay, I'm just curious.
Yes. So then we have on the last two pages are the two OPEB accounts. This is obviously different because the investments aren't running through the accounts, and so any of the transactions, whether it's the town's contribution, the employee's contribution, it's all happening in cash in our general cash pool. And so what happens is at the end of the year, there's a truing up that happens, and then that gets allocated to each of the OPEB accounts. There is some of the administrative costs that do flow through here, and there is some income that gets thrown off from the investments in terms of interest and dividends that do show up here. I don't know if there's much else to make note of here. You can see the change in an account value at the bottom.
It's really helpful to see it.
Yeah.
Yep.
Thank you.
And the last page is just the fire and police, consistent with the other one, saying fire and police. Any questions?
When Milliman begins, it will follow the same kind of apportioning out of cost.
That's right. Yep. Yep.
Are they doing that, or are you just doing that? In the sense that are they billing you separately for each, or are you just saying, I'm gonna do it on a percentage?
No, we do it. We do that.
You do it,
Yeah.
okay.
Yeah.
Okay.
And then they send it, and then typically they'll send an email to me with the breakdown, and then I can audit and make sure we've got
That's
the
right.
right breakdown, and then
Okay.
I sign off on it.
Gotcha.
There's the two signature,
Okay.
Yep.
well, two sets of initials.
All right.
All right.
Going to the next.
Let's go into the next. Thank you.
Yep. So an update on the RFP for pension payment processing. That's a mouthful. Pension payment processing services. I learned that TD, People's TD, that they actually had a meeting 2 days ago about M&T. I'm sorry. Sorry. Yeah, getting my
M&T block nations, right?
Yeah.
M&T. So they had a meeting about this specific issue, and just so everybody knows, it's
Very specific, or just in general for the?
No, in general,
policy?
yeah,
Okay.
yeah, and what they're gonna do and the transition from Peoples to M&T, their pension system. And so the good news is, I'm not sure, I'm gonna go back and get the details, because I got an email earlier today from our contact at People's Bank. And so they gave me what the pricing would be, because the issue has been the advices that are in the, that go along with the payments to the pensioners, that they haven't been sufficient. Pensioners aren't happy because it doesn't give them really a lot of information at all. And so, we had talked about this about a year ago, and we're ready to switch to another company to do this, who would provide that information. So now I'm learning that as of July 1st, we'll be transitioning to M&T's pension system, which will have the ability to do that.
Oh, we'll have the functionality.
They'll have the functionality. There will obviously be more costs. So that's the one thing that I want to look at, because, I mean, whether we do it with M&T or somebody else, there's going to be an additional cost related to it. But so I'll look at that cost and compare it to others of what I know, and if it seems like it's going to be out of whack, then we may still want to move forward with an RFP. But if it's not, and it seems like it's in line, I take the cue from you guys, but it seems like it's something that we could move forward with and then do pretty quickly.
So it's safe to say you're putting a hold on the RFP?
For now, yeah,
For now,
until I can
okay.
do that analysis.
So to catch you all up, right, some history on that, right? So Peoples had been doing this for the funds for ages.
Yeah.
And then they called up the town and they said they're exiting that business, and they gave us
Completely, yeah.
30 days, 60 days to get out,
something like
60
that,
days
yeah.
to get out and find someone else. And in that process of the scramble to find someone else, we identified a few, one being Pencheck.
Yeah.
But then People's reverse course.
11th hour, yeah.
At the 11th hour, and said, we're gonna keep it
Do it.
anyway, and we were in works of the switchover with the actuary, and so we decided to hold off and allow people to keep doing it, and so now we might have.
But the issue with the advice is that is that goes along with the payments remained. And at that point, at least it wasn't brought to my attention that this was a big problem a year ago, but since then it's kind of bubbled up and, been flagged as something that is a problem, and pensioners want more information.
Could I ask what they actually want? What are they, I'm just thinking, if I'm getting a social security check or something, what do I really want aside from a tax statement at the end of the year or something?
Yeah, I mean, I think it is that, like the accumulated aggregate amounts, those kinds of things, tax-related information, because right now it's just they get the dollar amount, what it is my understanding. I haven't actually seen one. Is that?
You just get the net. You don't know what your withholding is.
There you go.
Okay.
The state and the federal withholding or what any deductions, you just get a net.
What kind of advice did you get?
You get nothing. If
Right.
you get direct deposit, you just see a deposit go into your account, and that's it. Nothing.
Okay.
So 2 questions. I think we discovered way back the relationship with Peoples was so long, we never actually had an agreement or agreement we couldn't find. So are we gonna formalize this agreement with M&T if we do?
Which agreement? Generally, what are?
Yeah, just in general with the pensioner stuff that we could never find an agreement. At least that was, I thought, we never found.
Yeah, I think we updated that. Did we, if I recall?
Did we get something, a contract with them or an agreement in writing? Because I thought we never could find the original. It's been going on so long.
I don't know. Because I'm not certain what agreement.
Well, that they're managing our money for that they're allowed to do this, that we've contracted with them to do this service.
Yeah, I haven't looked into that, and I can follow up on that.
All right, and then 2, I guess, is the M&T merger change the position with Town of Fairfield, the relationship with Peoples, or are you guys still going to continue? Do you guys
as of right now, we're going to continue. Yeah, we don't have any plans to change right now.
Do you see that in the future? And so, I mean, do you pretty?
We'll monitor. We'll, as if we see some changes. So far, this being one example, the changes have been positive. So I'm not seeing any reason to change at this point in time.
Good.
Yeah.
Does anybody else chase our business? Does Citibank or B of A here in town chase our business?
Generally, the town's cash. There are definitely other banks out there that would love to have the business, and it's something I'm not sure. I don't know the last time that we went out to bid, or if we ever went out to bid, but it's something that we've talked about internally.
I'm just wondering if you have
gotten around to
multiple of the choices, or maybe you only have one.
No, there's a number of choices. Okay. Yeah. Okay, so that's that. Milliman contract. I expect to have that signed next week. It's just taken a while to go through because there are a lot of different options with the contract for a lot of additional services that they can provide. So, just been looking at some of those, and so I expect to have a signed contract next week.
How does that date of the signing impact or affect the work they've been doing now in preparation for taking over the payment, to taking over the kind of management? So is it still, are they kind of slow footing it, or are they waiting, or are they still, I don't know, what kind of expectation can we expect once the contract is signed in terms of them kind of getting up to speed?
So I would guess at this point it's probably going to be 6 months.
Okay.
The other thing that we have going on simultaneously is, and I mentioned it in my report, is the pension plan document.
Right.
That we're going through now. So we've been met with the attorney 3 times over the last couple of weeks to try to finalize that, and that's key for Milliman to have, and they've been in on these calls to be sure that they're in from the beginning and they know what the intent of everything is, so that becomes kind of the Bible for what they do, and there are and what this is there are general statements about what's in the pension plans. And then, but also they would have in the back of it as appendix, there is the specific information from each of the contracts.
Yep.
That's laid out in there, so.
Yeah, I think just in general, our constituents are looking for that, you know, that
Yeah.
an updated document and it is kind of underwhelming. I did reach out to a lot of our people and, you know, I'm like, hey, you know, the pension, you know, the way it's managed is changing and stuff like that. And they're like, okay, great. I mean, it was really bizarre. Like, no one was really interested. I'm like, you're going to get a lot more information. Hopefully it's going to be, you know, really a good service. Okay, thanks. It was really surprising. I don't know. So, all right. But yeah, that is one thing. Like, hey, we're going to get a new pension book. So that's what I think most people are kind of looking for.
Okay, yeah. Yeah, so, and as soon as it's done, we'll, as soon as we have a final draft done, it'll go down to the, unions and whoever else needs to look at it.
Okay. And I think then just the next step would be, I guess, we're going to maybe do a subcommittee on kind of the transition to the pensioners and what kind of the portal is going to look like and getting people the information and the training and all that kind of stuff.
Yeah.
Those be updates as we move along.
Okay.
Maybe we can set up some kind of whether it's a monthly or maybe we'll go to quarterly meetings at some point and we can give updates then. But yeah, we can set it up so that there are regular updates, or if there is something, something significant.
Yeah, as I said, I think Eric is very concerned about, we're not concerned, but just,
Right.
looking forward to kind of, seeing what his people, what our people on the other side are going to see and get them transitioned and comfortable and cut off a lot of those crazy questions and, so that kind of thing.
Yeah.
Crazy questions.
Yep.
Always.
Well, this is good. That's that's a heavy lift.
Yes.
Right, to be able to move forward.
But looking forward to it, I think.
Yep.
Yeah. Great.
And I had one other thing that wasn't specifically on the agenda, but if I could, just it didn't come up during the meeting with the attorney on the settlement, but just to let everybody know, we had a question about how that money gets divvied up between the pension funds, so the settlement money. And the answer is that we have the one funds account, and so all that money goes into there. So it doesn't get divvied up between fire and police and the town. It just goes right into the funds account. And then at the end of the year, that we look at all the ins and outs of each of the accounts separately to determine, what the value of each of the funds is, the fire and police and the town. So it's just, it's the investment's the same, the allocations are all the same because it is the funds account, and so there's no difference. It all goes into one pot. And we are, I got an email from the attorney today, and we sent him the wire information, so we should be getting that within, I don't know, tomorrow or the next day, I would think, very soon. Wow.
That's great.
Yeah.
Well done. All right. Thank you, Jared.
Yep.
All right. Anything else before we depart? Anyone else? Anything? All right. With that, if I could have a motion to adjourn.
I'll move it.
All right. Tom, Jared, second. I'm sure we were all in favor. Thank you.
All right.
Thank you.